Okay, so this topic is mostly going to be concerned with option trading strategies and the pricing of options in the financial markets. But first we'll just go through a quick introduction of what options actually are. So, as stated, an option provides the buyer with the right, but not the obligation, to buy or sell a financial asset at an agreed price in the future. And that agreed price is what we call the exercise price, or you might alternatively hear it called the strike price. So if you purchase an option on what we call an underlying asset, then at some point in the future you may either buy or sell the asset. However, you don't have to. You can actually make that choice. So there are some different types of options. We have the European, American, and exotic, which is just a sort of overarching term for all of the options that don't fall under these first two categories. The European option is the most simple type of option. Basically, it says that on a specific date, and only on that date, which we call the maturity date, you may choose to exercise the option. So you may choose to buy or sell on that day, however, not at any point before or after. With the American option, there is a maturity date. However, you can exercise the option at any point up until the maturity date. And then with exotic, there's all sorts of kind of weird characteristics you can give it. For the purpose of this course, we are only going to focus on the European option, because restricting the possible execution of the option to one single day really simplifies things, and when you're just being sort of introduced to options, it's a lot easier to deal with, so that's what we're going to go with. So we are just dealing with the European option. Now, furthermore, we have two main types of options, the call and the put. And very simply, the call is the option that gives you the right to buy the underlying asset, and the put, conversely, gives you the right to sell the underlying asset. So very simple. Now, a major thing that we have to look at throughout this topic is payoffs on options. So the idea is pretty simple. When you purchase an option, when the time comes at which you are able to exercise the option, you're going to have a payoff, which is basically the result of you exercising if it's a good idea, and then buying or selling shares accordingly to sort of make the most profit, so to speak. So to illustrate what I mean, we'll start off with the call. Maturity date comes along and you have the right to buy. Now, let's just assume that the underlying asset is a share. Doesn't have to be. But if the share price, which will denote S, is less than the exercise price, which will denote X, you have the option to buy at this price, which is higher than what you would pay normally on the market. So would you purchase at a higher price than what you can just normally? Obviously no, that would be stupid. So if you're not going to exercise the option, nothing happens. What is your payoff? 0. Now, if the share price, however, is greater than the exercise price, so now we say that you have the option to buy at a lower price than the rest of the market. Suddenly, it actually does seem like a smart idea to exercise the option. And how can you take advantage of being able to buy at a lower price? Well, purchase at the low price and then sell back into the market at the higher price. You basically make instant risk-free profit. So, your payoff in this case will be the price that you sold it for minus the price you paid. So it'll be the share price minus the exercise price. Now similarly, if you have a put, if the strike price is greater than the share price, then obviously you will in fact want to sell at a higher price than what the rest of the market can. And of course, in order to sell at the higher price, you'll want to purchase one of the share from the market at the lower price. And so you receive the exercise price after paying share price. And if it's the other way around, it's just not going to be a smart idea to sell, so you just let the option expire worthless, you get a payoff of 0. Now we can further express these as the maximum of Sx, S minus X and 0 in this case, and the maximum of X minus S and 0 in this case. Because note that if this condition holds, then S minus X will be positive. So if it's positive, you take that because it's greater than 0. If it's negative, you take 0 because 0 is the maximum. And the same sort of thing here. So these are our payoffs on a European call and a European put.
Cut study time with concise video summaries by top students. Visit spoonfeedme.com to view more free videos in this course and hundreds of others.